let's get across today's market moves. They were pretty big with business reporter Edward Boyd. Ed, it was the tech stocks. They got smashed.
Tech stocks got absolutely smashed today, Ross. The whole sector was down about 8%, and this is due to rising interest rates. Block, the US owner of Afterpay, it got hammered today, down about 18%. So did software company Altium. Accounting software business Xero was hammered as well. It reported a loss this financial year due to rising sales and marketing costs. Digital networking company Megaport was also lower, along with data analysis business Nuix. The ASX 200, that had another tough day today. It opened down about 1%, falling below 7,000 points, and it's at its lowest level now since February this year. The market finished down 1.8% today. Best performers, explosives and fertiliser maker Orica, they were the top performer after reporting an increase in earnings. Fuel companies Ampol and Viva Energy, they both lifted today. That's off the back of stronger petrol refining margins and very high petrol prices. Electricity generator AGL closed higher today too, along with the synthetic skid maker Polynovo. And just want to show you the big banks here. You can see Commonwealth Bank finished up today. National Australia Bank was up as well, but ANZ, Westpac and Macquarie Group all declined today, with Macquarie down almost 4%. And Ross, that is today's update on the banks.
Yeah, Ed, I really want to have a chat to you about the banks and really in particular that result from Matt Comyn today. Now, it's about interest rates and it's about the home mortgage market. And it was a quote today from Matt Comyn that caught both our eye, wasn't it?
Yeah, this is what Matt Comyn told the Australian Financial Review today. He said, "You've seen increasing competition and some of the pricing available in the market from some of our competitors is below cost of capital in terms of a return profile. So that is obviously business we are happy not to be originating and not matching." So in other words, there are banks out there, Matt Comyn is saying, that are undercutting the market and basically writing mortgages at a loss right now, Ross.
So what you and I did today was we went and crunched the numbers in APRA to try and work out who he might have been talking about, who is writing unprofitable business in the mortgage market. And we've got a few clues for you. So let's go to our graphics and we'll show you first up exactly this one. So this is basically showing the total mortgage market in Australia. In January, the mortgages in total were $1.28 trillion, so $1,280 billion. By March this year, that's risen by about $34 billion. So you can see there's growth in the system. So that's the first key, isn't it? That's the first one.
Exactly, yeah. Look, mortgages have consistently been growing over the last few years, and that's continued, obviously, in the first quarter of 2022.
OK, so then we go to those who are winning. So if we move on to the next chart, we can show you who's actually gaining the market share from that extra $34 billion. So this is pretty obvious, isn't it?
Yeah, look, we know Commonwealth Bank is the biggest lender in the country, and they grew their mortgage book by about $3 billion over that quarter, so roughly $1 billion a month. NAB did very well too. They lifted their mortgage book by $2.4 billion. Macquarie Group, they have really aggressively been lifting their mortgage book over that period of time, up $2.2 billion. And then you've got Bendigo there, along with the smaller lenders. And I just want to point out, Westpac was about $1.1 billion over that 3-month period.
OK, so that gives you some comparison. Then we move forward and we do it in percentage terms now. So this is market share to show you who's gaining and losing the market share. So during this period of time, you can see that these were the big gainers in market share. So we've got Macquarie, we've got the National Australia Bank, we've got Bendigo. Then you've got the Commonwealth Bank, and HSBC oddly slips into this group as well. So that's the next part about it. So then you go to, so this might give you a small hint as to who Matt Comyn's talking about. At the same time, this was going on, wasn't it?
Absolutely. So ANZ and Westpac actually both shrank their market share over that 3-month period. And ANZ, in fact, also lost in billion-dollar terms, million-dollar terms, mortgages as an overall number as well.
All right, then you go to the rates, and the rates give you a small sense of this as well. So if we move to those, what you can see with the interest rates on offer at the moment, the lowest rates that are available out there. So you can see here that some are still, prepared to lend at well below 2%. So clearly what Matt Comyn would say is that many of these lenders are potentially lending below the cost of capital. But also some of those who have been gaining market share could be doing the same thing.
Definitely. And I will say that these mortgage rates here, they're very specific. You must have a very high deposit to be able to lock in a rate under 2%, but they're clearly very popular loans at the moment.
OK, and then we go to the big four banks and we can show you what they look like in comparison. So there you go. The big four banks are well above that. But you can see here again, Westpac stands out. It's clearly trying to gain market share, while all of the others are pretty much locked in at the same rate there as well. So I think it's really interesting to note this, because I want to go back to that quote from Matt Common, because what this is giving you is a sense that some people are trying to gain market share. And the problem of that, as I see, Ed, and I think even Matt Common's getting to that, is if you're lending at a significantly lower rate right now, then there could be some fundamental problems down the track if all of a sudden, A, interest rates take off very sharply, or B, that your credit standards in making these loans have not been as good as what they could have been. So I think that's the key.
Absolutely. Look, I think a lot of banks are taking a bit of a gamble at the moment and locking in customers on these cheaper rates in the hope that interest rates are going to start rising. So they'll start to make a profit on those mortgages in the next 1, 2, 3 years when rates are higher.
And of course, they're hoping that they'll stay there for these 30 years as the mortgages are. But of course, we know that's simply not the market. That's not the way it works. So that's the idea, Ed. It might be actually a bit of a canary in the coal mine right now. Many thanks, Ed.
Thanks, Ross.